Hi students, this is Chapter 8, Receivables, Bad Debt Expense, and Interest Revenue. By now we shall be familiar with accounts receivable from our discussion on accounts listed on the balance sheet. So accounts receivable is just an asset. It shows the amount due from our customers for sales on account. And notes receivable is also an asset. It shows up on our balance sheet. It's an amount owed from our customers, but it's usually a loaned amount. It's binding by a lengthy written contract and usually has interest. There's some obvious advantages of extending credit to our customers. It increases our revenue just because we're able to sell more for customers who aren't able to pay us cash up front or at the point of sale. The disadvantages, though, of extending credit can be very costly. That means we have to have an increased staff to process credit transactions and check the credit history of our customers, to follow up with customers for payment, and then to plan for the cash inflows and outflows of the business, since we're not sure if they're going to pay us or when. And every business will probably face customers that fail to pay. So whether they choose not to or just can't, those uncollectible sales become an expense to the business. Since we follow the GAAP rules in accounting, that is the generally accepted accounting principles, we have to make sure we adhere to the matching principle. So if you remember when we talked about accruals and deferrals, we talked a lot about that matching principle. What it means is that we must match our revenues and expenses in the same time period in which they are incurred. So if we record a sale in a time period, its corresponding expense has to be recorded in the same period. Therefore, we have to estimate how much of the sales that are uncollected each period and then expense that amount in the same period. So that way we have our revenues and the associated expenses, in this case uncollectible amounts, they'll be in the same period. That expensed amount we'll put into an account to act as sort of a reserve in case down the road we confirm that our customers won't or can't pay. So there's two accounts that we're introduced to in this chapter, and the first one is bad debt expense. And this is the expensed amount we'll put on our income statement for estimated bad debts. And the other account is the allowance for doubtful accounts, or sometimes referred to as the allowance for uncollectible accounts. And this is a contra asset account to accounts receivable, meaning it decreases the value of accounts receivable on the balance sheet. It is a reserve account. So that's that reserve account we set up to cover for those uncollected accounts. Accounts receivable less the allowance for doubtful accounts is the net realizable value of accounts receivable. And that's what we expect to collect from our customers in total. This is also the amount that's displayed on our balance sheet. Okay, so remember, allowance for doubtful accounts is a contra asset. So it goes against the normal thought process of assets. It actually has a credit balance. And we're going to deduct that allowance for doubtful accounts from our accounts receivable to get that amount that goes on our balance sheet. That way we accurately report how much do we really expect to receive from our customers. Now the process of estimating bad debts expense and then writing off a customer's account is a two-step process we call the allowance method. First, we'll make an end of the period adjustment to record the estimated bad debts in the period for which the credit sales occur. Okay, so that goes with our matching principle, number one. And then secondly, we're going to remove or write off specific customer balances when they are known to be collectible. So that might be down there, that might be 5 years from now. Thankfully, we've already estimated how much we don't expect, and so that way we can expense it, and then down the road we'll actually write it off. Assume that VFC, this is just a company we're using in our examples, estimates $900 in bad debts at the end of the accounting period. Allowance for doubtful accounts is a contra asset account, and it's increased by $900. Now, that makes assets go down because it's a contra asset account. So that's why you see a negative 900 in our table here. And then the bad debts expense, which is a reduction in stockholders' equity, that's why you see it as a deduction of $900. That's going to be increased by the same amount. Okay, so we're in line here. Assets go down, stockholders' equity goes down. And then the journal entry to record this event is to debit bad debts expense, and that's just how we increase expenses through a debit. And then we're going to credit the contra asset account for the allowance for doubtful accounts, and that's kind of the reserve we set up. Okay, this contra asset still is going to be part of our balance sheet accounts. Okay, now let's assume that VFC writes off an $800 receivable from Fast Fashion, so that's just one of their customers, because the company could not pay its account. The allowance for doubtful accounts, that reserve we set up to handle uncollectible accounts, will be decreased, and then the asset account, accounts receivable, will be decreased by $800. And remember, the allowance for doubtful accounts is a contra asset account that reduces accounts receivables. All in all, there's no change to assets and actually no change to the net value of accounts receivable. In summary, these are the two journal entries to record the estimated bad debt expense and then to write off a customer's account. So here we estimated the bad debt expense for all of our customers in the first entry, and then we wrote off one customer. So that's why it's $800 and not the full $900, because this is just one of the customers that we're writing off. Our GAAP rules give us two main options to estimate for bad debts. First, we can use a percentage of credit sales for the period, or we can create an aging of accounts receivable report. The percentage of credit sales method is simpler to apply, but the aging method uses more detailed data and therefore is generally more accurate. So let's explore both of those methods. The percentage of credit sales method estimates bad debt expense by multiplying the historical percentage of bad debt losses by the current period's credit sales. Okay, so credit sales, we don't even care about cash. We're just looking at the credit sales because that's what we're collecting. And we have our historical average here in this example of 0.75%. So we'll multiply this credit sales of $120,000 by our estimated percentage of uncollectible of 0.75% to get bad debt expense this month of $900. So in this example, for the percentage of credit sales method, we are solving for the bad debt expense. So here we solved for the $900 of bad debt expense. And we'll go ahead and expense that amount and enter the amount, same amount, into that reserve account, the allowance for doubtful accounts. Now here's the second method. While the percentage of credit sales method focuses on estimated bad debt expense for the period, the aging of accounts receivable method, this is the second one, focuses on estimating the ending balance and the allowance for doubtful accounts. That's key. We're looking at the ending balance and the allowance for doubtful accounts. The aging method gets its name because it is based on the age of each amount in accounts receivable. The older and more overdue an account receivable becomes, the less likely it is to be collected. So let's prepare an actual aging of accounts receivable schedule. Notice that we show the detail for 3 customers and aged all other customers on a single line. So here's some customers: Adam Sports, Momentum Clothes, and Zoom Athletics, and then all of our other customers are on its own line. And so that was just for us to save space, and for when when companies do this, they can summarize it more easily. They might have hundreds of customers, so doing an Excel spreadsheet is a way to save time when preparing a schedule. So we have all of our customers: Adam Sports, Momentum Clothes, Zoom Athletics, and we have the time period in which the balances are outstanding. So 0 to 30 days, we have $120,000 total outstanding for all of our customers. So in this case, the business has been around for a number of years and has developed a bad debt percentage based on historical information. So notice that the longer the days unpaid, the higher the estimated uncollectible percent. Okay, so for that 0 to 30 days, in this case, we expect 1% uncollectible. But as the number of days unpaid gets longer, therefore the amounts become more outstanding, the percentage or likelihood of collecting those debts becomes greater. Of course, that makes sense. The long past due amounts are less likely to be collected. And then the third step here in the aging of accounts receivable process is to compute the total estimated bad debts. So in this example, they estimate $15,500 in total, just summing up the product amounts here, which is the sum of each category. This total will not be the bad debts expense for the period, okay? This is not the bad debt expense like the prior method we did, but rather it is to be the balance in our allowance for uncollectible accounts. So there's that $15,500 we solved for. That's the desired balance in the allowance for doubtful accounts. Okay, so if you're following along on your notes page, this example here is given. The estimated uncollectible is the product of the outstanding balance multiplied by the estimated uncollectible. So $160,000 of accounts receivable is outstanding from 1 to 30 days, and we're going to multiply that by 10%. That's the percentage that we estimate will be uncollectible to get an estimated uncollectible amount for that time period. We'll sum up each one of those categories to get a total. And so our total is $29,500. That's the desired balance in the allowance for doubtful accounts. Now, assume we had a $6,000 credit balance in the allowance for doubtful accounts already. Its normal balance is a credit because it's a contra asset account, okay? Goes against our normal thought process on assets. We want the ending balance to be $29,500 like we solved in our aging of accounts receivable schedule. So we have to solve for what the entry needs to be to increase that balance. Okay, that's the unknown. Using some simple math, we subtract our current balance from the desired balance to get the needed entry of $23,500. Note that the beginning balance was a credit of $6,000. Okay, so now had it been a debit, the math would have changed altogether. If a customer decides to pay us after we've written off the account, then we have to reinstate the balance back into accounts receivable. This is called a recovery. First, we put the receivable back on the books by recording the opposite of the write-off, and then we'll record the collection of the account. The first journal entry here we make is to reverse the original write-off of the accounts receivable. Okay, so our customer, we had written off $800, and we're going to go ahead and reverse it. So we're going to put it back in accounts receivable, and then we're going to credit the allowance for doubtful accounts. We can actually collect the money and record the entry for the receipt of cash. So then we will be able to debit cash and reduce accounts receivable with the credit. So that's how we are going to reinstate and then collect on an account that has previously been written off. So let's change gears here for a second. This is still talking about receivables. But let's talk about some financial ways to evaluate our receivable balance. The receivables turnover is the process of selling and collecting on goods and services provided to customers. The receivables turnover ratio indicates how many times on average the process is repeated during the period. That is, selling and collecting, selling and collecting. The higher the ratio, the faster collection of receivables. And then rather than evaluating the number of times accounts receivable turnover happens during a year, some people find it easier, at least I do, to think in terms of the length of time in days it takes to collect accounts receivable. Or in this case, we're going to call this ratio the days to collect. So here we see the actual ratios. The receivable turnover ratio, the first one that was mentioned, is the net sales revenue divided by the average net receivables. Make sure you're aware that this is the average net receivables. That is the average from the beginning to the end of the period. Okay, so beginning accounts receivables plus the ending receivables divided by 2. That's going to give us our average. That goes into our ratio as the average net receivables. We're going to need that receivable turnover ratio for our next one, which is the days to collect. The days to collect is 365 days divided by the receivable turnover ratio. And typically invoices give customers 15 to 45 days to pay. So having a days to collect ratio within that time frame is pretty standard. So you think about like getting your electric bill. It says on there your due date, and that's usually 15 to 45 days depending on where you live and what kind of service you have to pay the bill. And this ends chapter 8.